In the previous video, we talked about the shape of the yield curve and how to use the yield curve as an economic indicator. To recap, the slope of the US Treasury yield curve, as measured by 2-year and 10-year yields, is one of the most reliable leading indicators of a recession. Since 1976, it has accurately predicted every recession in the US without any false signal. So where do we stand now? The spread between the 2-year and 10-year yields rose steadily from February 2020 to March 2021, as the markets foresaw a smooth reopening of the economy and as monetary and fiscal policies continued to stay accommodative. Since April 2021, several factors have pushed the Treasury yield curve to flatten. For the long end, rising 10-year US Treasury yields have seen setbacks on uncertainty surrounding the economic outlook due to the Delta and Omicron waves of the pandemic, in addition to expectations of scaling back of the asset purchases program by the central bank, which theoretically leads to the reversal of quantitative easing policies. These have clouded the path to economic recovery. More recently, intensified geopolitical tensions between the US and Russia has also triggered a risk-off sentiment in the market and reversed the sharply rising 10-year yields. For the short end, 2-year US Treasury yields have been pricing in more aggressive rate hike expectations of the central bank to rein in inflation that is running at its fastest pace in decades. As of January 2022, 2-year US Treasury yields rose above 1% for the first time since the start of the pandemic, further eroding the advantage of a yield pickup of holding securities with longer maturity. This has sent the spread between the 2-year and 10-year Treasury yields to its lowest level of the year at 72 bips at the end of 2021, where the yield curve continued to flatten. As the shape of the yield curve reveals investors' expectations for both growth trajectory and monetary policy, an anticipated slowdown in growth momentum and a more hawkish stance by the central bank on sooner-than-expected rate increases to combat inflation will likely push up short-term rates faster than the long end and continue to flatten the yield curve. Let us take the previous rate hike cycle as an example, when the Fed fund target rate was increased from 0% in 2015 to 2.25% in December 2018. 10-year Treasury yields increased from 2.3% to 3.2% during this period, while dropping temporarily below 1.5% in 2016. 2-year yields followed the path of the policy rate, steadily rising from 1% to 3% at the end of 2018. This has pushed the spread between the 2-year and 10-year US Treasury yields all the way down from 150 bips to 10 bips at the end of 2018. The market is now watching several major events that may impact the future shape of the yield curve. How aggressive will the Fed hike the policy rates to contain inflation? Financial markets are expecting that the Fed could raise rates as many as 4 times this year after post-pandemic stimulus measures caused inflation to rise sharply. More importantly, is the Fed already behind the schedule to shrink its $9 trillion balance sheet and remove liquidity from the financial market? The negative impact from the combination of rate liftoff and quantitative tightening that caused financial markets to correct significantly in 2018 cannot be underestimated. We've now come to the end of our series on the yield curve. To find out more, please get in touch with us, and see you in our next edition of SingAlliance Answers.